All right. Well, welcome everybody who is joining us today. My name is Craig O'Boyle. I'm with Assumption Solutions, and I am here at the invite of Deborah Rose Miller of Houston and Old Republic Title of Kingwood, Texas. So I'm very thankful to be here to present to you today on the VA and FHA mortgage assumption. And Deborah, I know you wanted to say a few things,
I
especially since
do.
we're recording this. Go ahead.
Thank you, Craig. I know with participants you're missing our fun time here in the conference room and pizza that Old Republic so kindly gave us on our Friday. But I wanted to, the reason I'm bringing this to my realtor friends is I'm on my second assumption of the year. So if you haven't done one yet, it's probably not if, it's just when. And I wish I had known Craig in February. My life would be easier. My hairdresser would not have to be coloring my gray as much as she's having to right now, because I'm on day 54 of an assumption from hell. but we're going to get through it. So what Craig's team offers is just amazing, and I want you all to have the opportunity to get to hear it before you need it, not after.
Well, thanks. I wish I could get such a great intro on every class I do. I appreciate it very much. We strive to be a big resource here. So unless there's anything else you want to cover, I can dive right in. So
That's
we
it.
make the most of everybody's time. We try to do this in less than an hour if we can. So. All right, I'm going to click through the slides here. Just give me a quick thumbs up if you can't see the slide in the chat, and I'll adjust, but hopefully everybody can see it now. So, all right, so we'll start with the slides here. Now, I will warn you, you have to put up with a little bit of my sense of humor. It's not always everybody's sense of humor, but hopefully it keeps us from being too dry here. So every now and again, I like to pop in a little meme. So this first one, we're talking about interest rates, of course, and when bottoming out is a good thing. Assumption solutions. How low are interest rates on assumptions? Well, hopefully as low as this pickup truck, which I actually shot this photo. I was very proud of myself when I made my first meme here. This thing, I don't know how it gets in and out of a parking lot, but apparently he does. So obviously, this is why assumptions are attractive, though, because it's all about that low interest rate since things changed in 2022. All right, so let's talk about the agenda we're going to cover. First thing, we're going to do a mortgage loan assumption overview, talking about it and the process, the assumable loan types and eligibility for people in that area. We'll talk about the value of a loan assumption. This is kind of where I get to nerd out a little bit in numbers. So once again, hopefully it's not too dry, and I'll sprinkle in a little humor here as well. We'll talk about the assumption process steps that you go through and that we help take you through. And then what we charge to help people through this process, of course. And then the evolving market, which is about things that have changed since this started, really in about March of 22 when we started in this area. Things have evolved. And so I'll cover some of the things that have changed over that time. And then I'm going to switch gears. I'm going to put my realtor hat on. My background is I have been a licensed realtor since October of 1995, when I got my license at 19 years old, while I was going to college, and kind of started helping my father in the business. So I'm a very agent-centric person because that's my background. And so I'm going to talk about great ways for you to thrive in this market. All right. So first, let's talk about a mortgage loan assumption overview. Well, a mortgage loan assumption occurs when a buyer agrees to take over the existing loan of a seller, becoming responsible for its repayment. There are two types of assumable mortgages, qualifying and non-qualifying. But non-qualifying assumable mortgages are really now rare, if non-existent. They went away in the late 80s when the government entities basically decided to make them all qualifying. When I was originally licensed in 95, we'd occasionally see one of those pop up. And if we saw them, we'd run out the door and try to buy them ourselves, because basically you just said you wanted to do the deal and you could. But that's all gone. So now most assumable loans require that the buyer meet the same qualification standards as the original borrower. All right, assumable loan types and eligibility. Nearly all qualifying assumable mortgage loans available today are either VA or FHA guaranteed loans. Some of you may have heard or know a little bit about USDA. I'm not going to dive into that area. We aren't seeing any of those really happen. So we're going to focus on VA and FHA guaranteed loans. VA loans can be assumed by both veterans and non-veterans. However, only when the assumption is made by another veteran with sufficient VA entitlement will the original borrower's entitlement be released from the loan by substituting the new buyer's entitlement. So eligibility, entitlement, kind of interchangeable words there. A lot of people understand that veterans have a special benefit because they have served our nation to get a VA loan. And with that, they have something that is called entitlement. It's almost like a dollar amount of loan guarantee that they can go out to use to get a VA loan. If they do a sale and that is to a non-veteran with no entitlement, because somebody's entitlement has to be attached to any VA loan at all times, the entitlement of the seller will remain attached. And I encourage agents, though, don't prejudge whether a seller is okay doing that or not, because we see that sometimes anywhere from 3 to 4 out of 10 people that go through this process sell to a non-veteran. And the people that make that decision do it for various reasons. The common reasons we see where a person might be okay leaving their entitlement, number one, is maybe they're elderly and they're not going to get another loan in the future that's going to be a VA loan. And so they're okay with leaving it. We see commonly where there's two spouses who have VA entitlement, and they're like, well, we'll leave this one and we'll use the other spouses. Uh, Another common reason is simply it's whatever sells the home, right? They're just in a situation where they need to move on and they make a choice because they are released from liability on the loan, right? If that loan goes bad in the future, it doesn't come back on their credit and they're not liable for that loan. It's on the new borrower who has qualified to take it over. So it would affect their entitlement, of course. If you go to a non-veteran sale, that doesn't mean that they can't get a future loan. It just may mean that their ability is reduced by whatever is remaining on the loan that they're leaving. So they still may have some entitlement left to give when they combine it with the cash that maybe they get out of the sale and the price and the location they're going to get another VA loan. So once again, I just very much encourage people leave this decision up to the seller. Make sure they understand how it works, and we can explain it to them in depth if needed, but there are people that go that route. Now, if it's a sale where the buyer has a veteran entitlement, they can do what is called a swap. But that buyer has to have sufficient entitlement in place to do the swap. If they own another home somewhere else that they're keeping and maybe turning into a rental or something, and their entitlement is below what is needed to do the swap, even by $5, you have to have the total amount. You cannot do the swap. Unlike in a new loan situation, you can do something with a down payment where you buy additional entitlement. You cannot do that in an assumption. So just keep that in mind. Regarding FHA loans, which are also assumable, though they do not involve any entitlement issues like VA. However, it is important to know that FHA loans carry mortgage insurance as part of the payment for the life of the loan. With VA, the mortgage insurance is done through a funding fee. It's not part of the monthly payment. So both VA and FHA loan programs are primarily intended for owner-occupant purchasers, but I'm going to address some changes in our evolving market slide as we get a little further down. All right, let's move on here. This is my favorite slide. This is where I get to go into numbers. So once again, I hope I don't bore you, but this, when you master this and you're able to understand this and communicate this stuff to clients, both buyers and sellers, this is where you really get the people who want to do a transaction. So there's 4 columns here, obviously. The first one we're going to cover is a payment comparison, and I call this the top line number. This is what really gets people into this market because they're excited about it. So, all right, we're going to look at the payment, a $400,000 loan at, say, 7% interest rate, which is equal to a monthly payment of $2,661, or a $400,000 loan at 2.75% interest, which is equal to a monthly payment of $1,633, which is equal to a monthly savings of $1,028 and an annual savings of $12,336. Those numbers right there, I guarantee, get every buyer excited. Who doesn't want to save $1,000 a month in their payment? All right, now we're going to look at the effect of the change, which things started to change a little over 3 years ago, about March of 2022, and how that affected the purchasing power for people in the marketplace. So we're looking at that monthly payment of $1,633, which is obviously 2.75 at 400,000, or a $245,500 loan at 7%, which is a decrease in purchasing power of $154,500 to keep the same monthly payment. That is the crunch, the affordability crunch that people have felt for the last 3 years. This is what we as agents have been dealing with, right? So purchasing power is now reduced to only 61.4% of its previous level. Now, obviously, that's at that 7%, and rates fluctuate, of course, but this is still the biggest issue that people in the marketplace are dealing with. All right, now we're going to move to the next column. This is the number that the most financially savvy people are really paying attention to, and this is interest saved over time. This is where wealth is built. And in this, I will also do a little bit of an example of an assumption as well. All right, so total interest paid on a $400,000 loan over 30 years is $558,000 and change at 7%, or $187,868 at 2.75%. That's a total interest savings over 30 years of $370,000. That's massive, right? Those numbers blow my mind every time I look at them. But let's look at this deal. Let's look at this, say the 2.75% rate, and let's say it goes on the market and somebody comes along and wants to assume it. Well, remember, in amortization schedules, interest is front loaded, right? So interest paid in the first 3 years of the loan at 2.75 is just under $32,000, right? That means over the next 27 years, if somebody assumes that loan and keeps it, they are going to have an interest savings of $402,106, which exceeds the original mortgage balance that was taken out by $2,106. Blows my mind. And if you can communicate this to clients, I guarantee you they're going to do whatever they can to jump on the opportunity because it is massive. Now, keep in mind, these numbers, they'll be a little bit different depending on what market rate is for current rates and what the rate is that's being assumed. Believe it or not, we have seen interest rates assumed as low as 1.75%. So that's even wider. I mean, I think that must have been available for one day or something. I don't know, but we've seen a couple of that. The last column I want to talk about here before I lose anybody in the numbers is a deal that we were involved with that I never thought of until we did it. The funny thing about this deal, it was in Colorado Springs. It was actually just up the road from a house I live in, and I'm almost sad I didn't buy this house. So this was an older loan with higher interest. There was a $500,000 loan originated at 5.29% in 2009 and had a payment of $2,773. The remaining loan balance 15 years later in 2023 was $358,759. The sales price of that house was $900,000, and there was an assumption gap, which is the difference between the price and the loan being taken over, of $541,241. So big gap, but the buyer of this home had sold something in Hawaii was coming to Colorado Springs, so they had the cash gap. The interest paid by the seller of that home over the first 15 years was 336,421. And like I said, interest is front loaded on amortization schedules. So that meant for the next 15 years of payments, the interest remaining to be paid was only $164,000. So not only did they get a 15-year loan, most of the interest that's collected had already been paid by the seller of that home. So this slide here, I love it. I think as many of the agents out there can post this kind of stuff when they have great listings, they're just going to get so much traffic when you master these numbers because people are looking for these numbers. All right. Now let's go into the assumption process steps, right? That you're going to take whether you're working for a buyer or working for a seller, and then hopefully have us to come along and kind of help you as a transaction coordinator through the assumption process, right? So the first thing you want to do is you want to confirm the property has an assumable FHA or VA loan, right? You want to review the existing loan documents carefully. Carefully, all parties should pay close attention to the loan amount, the interest rate, and the payment terms. Those ultimately are the asset that you are either marketing for sale or that you're looking for your buyer. That is not something that you want to hide. That is something you want to market. You want to obtain an ownership and encumbrance report from, let's say, Old Republic Title, right? And you want to look at the deed of trust. You're looking for basically an FHA or VA case number to make sure it is an assumable loan. Conventional loans generally are not assumable because they carry a standard due on sale clause with no assumability clause. I will put a little side note there because we actually do a lot of these. We do see that conventional loans can be assumed by one party in a divorce, and we actually help a lot of people in that scenario. So I will mention that out there. It's usually got to be in the divorce decree and things like that. But in general, they do not carry a qualifying assumption clause. So, all right. Then ultimately, you need to execute an assumable purchase contract, right? The servicer assumption approval, because they are who approves this, right, can take 45 to 120 plus days. Now, I don't want to scare anybody when I put that up there. Keep in mind this slide's a little bit old. The average in here says 60 to 90 days, but some deals are going as fast as, it's not even in here, but 25 to 45 versus I'm going to say 45 to 60 like I've got written here. We do track the servicers in how fast they're going. So I will say, give us a call. We will check because we track like how long they have been taking so that we can give an idea for people on what to expect. But the biggest thing in here to expect when you're doing your contract is a little bit of uncertainty. What we see with servicers, the two factors that affect your timeline more than anything else are one, how their systems are internally for processing and approving these, and their deal volume, right? If they take in, let's say, I don't know, 100, 150 deals in a week, even the best servicers who are maybe getting them consistently done in 25 to 45 days are probably going to back up. You know, if they lose some staff, they're probably going to back up, right? There's guidelines out there from the government entities of how fast these are supposed to take. But I will say that until those entities maybe have a little teeth on the servicers, we see many that aren't meeting those guidelines. And but they are getting much, much better. Consistently in 22, you know, 3 months would have been fast. 120 days would have been average, and some were going beyond. But they've all sort of gotten beat up by the servicers. Thankfully, we've actually done a lot of training on them. There were servicers out there initially that were telling people they didn't even have to do these when it's a guaranteed benefit of the loan for FHA and VA, and they didn't think they had to do them. So everything is getting better. So take a deep breath, but be patient when you do this process. Buyers need a plan for the gap between the purchase price and the loan amount. Usually what we see, it is a cash down payment, but I'm going to address once again some things that we've seen change-wise in the evolving market slide when I get there. Flexibility and advanced planning are essential as the process may take time. I do think coordination and communication between the agents, the buyer and the seller's agent, is key. Understanding people's timeline. If you've got a seller who's like, I absolutely need a check and I need to be closing on my next house in 25 or 30 days, they may not be a great candidate for this process because I hate to say it, the servicers sort of don't care what your contract says. They're only able to move as fast as they're able to move. So we have some strategies that, as part of our help in these process, that if they're going abnormally long, we can say, hey, this is where you need to make complaints, and sometimes complaints, well, they get things done. So, but once again, that's all dependent on government agencies. All right. Now, what we hope here, of course, is that you send the contract to Assumption Solutions. So we can function as your assumption transaction coordinator. That's the way to think of what we do. Assumption Solutions will vet your transaction to determine if we can help you be successful rather than you waiting for weeks or months for a servicer to review your submission. We see on average that the submissions to the servicers aren't reviewed for anywhere from 2 to 4 weeks, which is a heck of a long time to be in a contract not knowing if it's likely to succeed. We'll look at it with our trained eyes. I mean, we can't make guarantees, of course, because it's all done by the servicer, but we do a lot of these all over the nation. So hopefully we keep you out of deals that aren't going to work. We'll then help you navigate the submission to the servicer, ensuring it's done right the first time, as errors will lengthen the timeline. If it's done wrong and they finally get to it and they start to process it, they're going to kick it out. And from there, you might have to resubmit and you kind of go back to the back of the queue. So you lengthen that timeline. Our goal is to help you stay away from that. Servicer assumption approval. Assumption Solutions will then continuously and regularly follow up with the servicer to ensure they are moving the file forward. We're kind of the pest that keeps them moving this thing forward. We'll help you understand the process at each stage and adapt as needed. Now, one of the nicest things is having gone through so many of these, we've developed relationships with these servicers where, if you call them, you're kind of going through that phone tree, which we've all done on many occasions, probably with mortgage companies. Well, we have internal contacts that sometimes if things aren't going right, we can go to that next level real quick and say, hey, why aren't you guys moving this forward? What is the issue? So, but at the end of the day, the servicer takes in and processes the assumption application. Once they grant assumption approval and clear to close, closing can be scheduled, right? But timelines may vary, so remain flexible. That's the key with all of this. All right. I know a little bit of dryness. We'll throw a little humor in here. We'll see if you like it. If not, I can't hear anybody laughing or scoffing. So that's the good thing about Zoom. Real estate buyers before and after. You've got 3 people in here who didn't use you or me as their agent, right? But then you got the one in the right bottom corner who did. Well, our goal at Assumption Solutions is to be keeping you from being any of those 3 people and your clients from being those 3 people to make this process as simple as possible. All right. Another iffy joke. We'll see. All right, pricing. What do we charge? What do we do for charge for what we do? Assumption Solutions charges each party a $950 fee, totaling $1,900 per transaction. However, the first $50 is due at engagement from each party, with the remainder payable only if the servicer assumption approval is issued. See, our goal is to be low cost, low risk, high value. So our seller success fee $950, our buyer success fee of $950. Now, servicer and government assumption costs, things to expect in the transaction. Servicers have a processing fee, but we often see it's less than $1,000. This is probably the biggest reason that this is not as simple as it could be. It's not a profit center for servicers, right? And keep in mind from their perspective, right? Keeping a 2% rate on the books versus clearing it and being able to lend that money at 6, well, there's motivation there. So this might be why we have found that this process doesn't go as efficiently as we would all like. Government entity fees on a VA loan, you have the funding fee, but it's less than a new loan. you have a 0.5% funding fee to the buyer unless that buyer has a qualified VA disability, which can waive that fee. Outside of those, you don't have any of that with FHA. I mean, you do have the processing fee that they'll charge in there. But outside of that, you're generally a lot less in terms of cost than the cost of obtaining new financing, right? I mean, just on the VA funding fee alone, I think it's close to 3% on a new loan. 0.5% is a lot less. Now, it's not financed in, it's paid as part of the closing cost, but you don't have a lot of the other charges that you generally have when you have new lending fees in there. So a couple examples just to talk about this. Our fee is $1,900, but at the end of the day, it's really subject to whatever you guys decide how it's invoiced out. But the most common way we see it split: seller success fee $950, buyer success fee $950, upfront engagement $50 each. Assumption approval and clear to close issued. The remaining $900 is per side is invoiced. We look at us much like a home inspector or anything else, right? Like we invoice when our work is completed. But it can be paid by one party, be that the buyer, the seller, or a third party, right? So success fee $1,900, $950 per side, upfront engagement $100, $50 per side, and then the remaining $1,800 it's invoiced out when they get you through the process. All right. Once again, though, our goal here is basically to be low cost, low risk, high value. And I will mention, we think we hit that target really well. There is competition in the marketplace. I'm not going to name them, but I think they came about after learning about what we were doing. And a lot of them are backed by Wall Street, believe it or not. And their cost structure is much higher than ours, upwards of 1%. That's not us. I'm a veteran myself. I wanted to create a service that I felt offered value to the marketplace, to both realtors and veterans. And I wanted to do it at competitive pricing. So, all right. Let's talk about the evolving market now. So things that have changed since we started this. Number one is the possible changes to occupancy requirements. Investors. Investors cannot do assumptions on FHA transactions. They can only do them on VA transactions if the seller agrees to leave their entitlement attached to the sale, and if they do it only in their personal name. So an LLC, a trust, a C Corp, an S Corp, they cannot do an assumption, but an individual investor can come along on a VA deal and do an assumption. FHA does have to remain owner occupied in the assumption. That doesn't mean that, you know, a year, 2 years down the road, you couldn't turn it into a rental in either scenario. But if you're buying an FHA, you better move into that thing. Do not commit loan fraud. All right. The potential for obtaining secondary financing for the gap. This by far is the number one question we get asked and have for the last 3 years. Truth or rumor, I do not know, but early on, there was no possibility. Well, we thought there might be possibility of secondary financing. We started, and then all of a sudden it was like, oh no, because word started getting out that if anybody was going to do secondary financing, that secondary financing needed to be assumable. And there just aren't assumable second mortgages. They do not exist. And then I think about August of last year, the VA issued some guidance that basically said, we don't care about secondary financing. You can do a second as long as it doesn't interfere with our first mortgage position in any way. And so that marketplace has started to go. We're not in the financing market, but of course, being connected in this space, we get all different kind of organizations reaching out to us. And some of the people that are in that space have let us know, basically, and through processing deals, what kind of things we're seeing out there. Generally, what we're seeing is they are doing purchase money HELOCs, or home equity lines of credits, on the specific property. We are generally seeing that the loan to value between the first and second, or the CLTV, cannot exceed 90%, which means that the buyer would still have to have 10% down of the total purchase price. So for example, a $500,000 sale with a $400,000 loan, a $100,000 gap, that would mean that they'd have to have $5,000 or $50,000 down. as cash down payment, but they could potentially get that HELOC for 50,000. Now, generally, because they're HELOCs, most HELOCs, I personally have one, they run off of the Fed funds rate. And so they're a spread above that. So you're probably going to be looking, I'm guesstimating, somewhere 8 to 10% out there. But we don't know. You have to check with the servicers that offer, the lenders that offer those. And then you would have to qualify with the blended rate between the two, right? And that would also trigger something that you don't have on a standard assumption, which would be an appraisal. With assumptions, the appraisal was done on that mortgage when it was originally issued, so you don't need one. But if you're going to get a second, of course, that second's going to want an appraisal in there. And so to make sure that you're not above those thresholds. And then qualify for the blended rate with your debt to income ratio out there is going to be a factor as well. But this, I expect to see this part of the market grow. Check with your local lenders, see what they're willing to offer. Reach out to us. We can tell you the organizations that we have seen doing it, but you got to go out to them directly. Handling of escrow accounts. This is the Wild West still. We're all pretty familiar with how escrow accounts generally get handled between the buyer seller and through the title company. But depending on when that escrow account, like last paid taxes, last paid the insurance policy, there could be things like shortfalls and a lot of different things in this scenario. Now, the buyer's going to get a new insurance policy, right? The seller's insurance policy isn't going to transfer with the sale, so there's going to be that piece in there. But there is a little bit of wonkiness in there. What I'm consistently saying is you just sort of got to roll with whatever the servicer decides they want to have happen. Some servicers actually do give you a bit of a voice, right? Like let you say, okay, how do we want to handle this if there's a shortfall, or if we're doing a distribution, or is it transferring and stuff like that. Some are dictating how it's got to go. We would love to see more uniformity out there, but right now it's not there. All right. The next one here, VA eligibility restoration timeline. This one is a holdover thorn that I sure hope gets fixed fast. So let's say you help a seller sell their house and they do a swap with a buyer who's got entitlement, right? Their eligibility being swapped happens post-closing. The guidelines from the government entity, the VA, are that the servicer has 45 days post-closing to notify VA of the swap, and VA has another 30 days to reinstate that entitlement, which means a potential seller can have 75 days in between selling that home to getting their new VA loan. That's nonsense, if you ask me. I mean, right now you can sell a home and a buyer gets a new loan, you can go down the hall and you can buy your new home on a VA loan. This is a holdover. There's no reason it should take that long, but it is what it is. Our recommendation, it's not something we can help with, is the seller just really needs to pound post-closing on their servicer. I need this, I need this, I need this, I need this. Be that pest, right? And then we have found that when they pester the VA has actually been pretty quick as far as getting it reinstated. Hopefully this gets better. And we do these classes all the time. We're watching it all the time. As soon as I can, we send out emails. I will let the whole world know that this has changed. But right now, be prepared. If you absolutely need to use that VA right away, post-closing, an assumption may not be the best scenario. So keep that in mind. All right. Now I'm going to switch back. One more piece of humor, but I'm going to switch to the real estate side of this, right? So closing more deals. They said it would be easy. Being a real estate agent is the least stressful career I've ever had, said Jessica, 29, who obviously looks 29. And then you go to the doctor. What is your occupation? Me, I sell real estate. Do you drink? Yes, I told you, I sell real estate. We can probably all relate to that over the last several years. All right, hopefully you're laughing. I can't hear you in Zoom land. All right, closing more deals. There's nothing radical I'm going to give a lot of you here, but we're going to talk about three things: how to get more sellers, how to get more buyers, or I should say we're going to talk about 4 things. Then I'm going to talk a little bit about something that I found really became important early on in this process. And I'm going to talk about when you get that listing, how to properly expose it to the marketplace, right? Because making the most of your seller's asset is your job as a realtor, and that's what we're going to talk about there. And then I'm going to talk a little bit about some things that have come into the marketplace that are very helpful to know about and that have made this market get even more buyers and sellers in it that you should look into. Okay, so first, market to potential sellers with assumable mortgages to secure more listings. Right? First thing, reach out to past clients or your network with assumable loans. Highlight the value of assumable mortgages in a rising interest rate market. Use social media to educate homeowners on assumable mortgages. Link our content to your pages. Anything we put out there, you are welcome to use. Create educational videos or posts that explain the assumable mortgage process to the public, showcasing your expertise. Hey, you're taking this class today, you're becoming an expert. Use farming tools to identify properties with assumable mortgage loans originated or refinanced in the last few years. I will say that the best rates were issued between March of 2020 and about March of 2022. Those are when things were generally below 3.5%. And you might be surprised how big the market is. When we started this, we did a check just in the Colorado Springs area, which we have a lot of military bases in Colorado Springs. And in one county alone, we had 14,000 loans originated in that time frame that probably have a loan below 3.5%. That's one of our counties. So it's pretty big. Now, talk to Old Republic Title. They can help you look into a lot of that. So once again, I say your title rep can assist you with farming, I'm sure. Teach classes to homeowners about the value of their assumable loan in a rising rate market. Now, we do have on our website a listing presentation flyer, basically designed to just tell a seller about the special thing that differentiates their house from maybe their neighbors who doesn't have an assumable mortgage. You're welcome to use it and incorporate it into your listing presentation. All right, let me wet my whistle. Target buyers who could benefit from assuming a low rate loan. So reach out to the same thing, your past clients, anybody in your network who may be most payment sensitive. We brought buyers back into the market in our real estate company back in 22 who dropped out when things went up. You probably can do the same by showing them those numbers that we talked about earlier and how they can save maybe upwards of $1,000 a month. All right, let's keep going. Use social media to educate buyers about assumable mortgages. Share real examples of payment savings that can be achieved by assuming an existing loan. Feel free to use our examples. Collaborate with listing agents to promote listings, showcasing mortgage and payment details and highlight the benefits of low rate loans. I have done this in my real estate company. I will go out and I will look at other agents' listings and I'll be like, okay, I will go then take my ID from my IDX website and I'll be like, hey, here's a listing that's on the market and here's what the payment on this thing is. And I have seen just massive amounts of web traffic going to my website whenever I do that. Now, I know as a listing agent, anybody that wants to help me sell my listing faster and for more money is welcome to help me. So collaborate with other listing agents out there. We all want to move homes as fast as we can. Engage with your veteran community, explaining how assuming a VA loan and swapping entitlements with another veteran benefits both parties who have served our nation. You know, those veterans who have entitlement to swap makes them the most attractive potential buyer to the sellers out there. Even if the seller's willing to leave their entitlement, if they don't have to, of course, they would probably prefer not to. Host buyer classes about the value of assuming a low rate loan in a rising rate market. Use our examples, and we'll even teach with you if you need us. I have gone to classes that agents have put on, whether it's Zoom or whether it's in person. Obviously, it might not come down to Texas just to help you teach a buyer class, but if you need me, I'll try and help as best I can. All right, now let's move on to talking about once you get that listing. And I think being a listing agent for these is actually the ideal position. because you just have an extra leg for marketing, right? You still have the ability for the home to sell for cash buyers or conventional loan buyers or any other new loan buyer. But now you have those people who are looking for that low rate loan, and you market it out there. You might be surprised how much your odds of double ending a transaction go up when you properly expose this asset. So, number one, use MLS fields for assumable mortgages. Enter details like loan type, balance, interest rate, and payment. Our MLS in Colorado Springs had a section for assumption information in it, standard forever. It defaulted to no, and so nobody even knew it was there. Nobody ever used it. And so we did a lot of training about the importance of getting that information out to your people, right? Include the monthly payment in remarks that syndicate to public sites. Not every MLS, you can't always do that in certain MLSs, but a lot of the public sites like Zillow, Realtor.com, other places do let you go in and edit. The more you can get, the payment, the rate, all that stuff doesn't change. It's a fixed asset of the property, right? So the more you can get that out there and don't hide it, you're just exposing the asset and what can be bought on this property. And that is the differentiator for your listing. So get that out there. Use social media to showcase the listing, emphasizing lower payment versus similar homes without an assumable mortgage. Many Facebook groups are out there now that are dedicated to VA and FHA assumables. Join those groups, get them in there. We're members of those. I see buyers in those groups posting wants and needs all the time. I see agents putting out there, start one if you don't have one in your local marketplace. I mean, they're being hunted. Highlight the assumable mortgage and payment savings with flyers, open houses, sign riders, basically anything and everywhere that you already normally market. Whatever is cool about the house you're selling, you want to market this information. Now, show another thing that's positive, we think, show buyers and their agents that Assumption Solutions will assist you through the process to ensure you get through it smoothly, right? Without a doubt, we hear this 3 to 4 times a day from agents who reach out to us. You know what? I've never done this. I've got no experience in this. I don't know how this works. And they're very nervous, right? And so being able to show somebody that you have a team member that can take them through this with experience. I know what we're experts at as agents. I'm one. I've been one forever, right? We're not experts at this kind of thing. Where we spend our time best is prospecting, taking listings, writing contracts, dealing with the mechanics of a transaction. This is totally foreign. And so being able to show that you have a team member that can help all parties through this, it really, really, really will make this more simple for everybody involved. All right. Now some things that have come into the marketplace that I think are very much worth your time looking into. Now, obviously, I put our website in here. Classes like this, the reason we record them, we put them on there so that buyers, sellers, agents, anybody can take them at any time, right? Have our resources, have our information, reach out to us. So assumptionsolutions.com is the first thing I mentioned in here. Bookmark it, send it to people when you need to. But the cool thing about being in this, and I kind of think we invented this industry when we did it in 22, sort of modeled after anybody that was around in 2008 and dealt with short sale processors. I mean, we're kind of trying to help in that vein, right? So, but being early in this, all these different groups reach out to us. So the one that I'm going to talk about next is a website called assumelist.com. It was started by an agent in Virginia, and what he does with assumelist.com is he goes around and he joins MLSs all over the country. He's not in every marketplace. He's definitely in Houston. I do know that. He's got basically a search platform dedicated to assumables. It's a for-pay platform, but I think I join it and I pay for it. I'm not promoting it because I get anything out of it, but we build our buyer searches in this platform because it doesn't matter how a property is marketed. If it's got an assumable mortgage, it will show up as active. So when we have somebody hunting, we build our search in assumelist.com. But here's the other piece I love about the website. It has the ability to search off-market property with assumable mortgages as well. And so it can be used as a prospecting tool for either helping buyers to find a home if they're active, but they're not finding what's on market, or for just looking for sellers. So I love it. They kind of do promote us as well. They call us their easy button tool to agents. It's the same process that we're talking about here, though. You can come direct to us. Another one out there that's really cool, AssumableSales.com. It was started by the people who started the largest VA Assumable Facebook group. And what they do, the realtors there, you come in, they're designed to connect people through the Facebook group with realtors around the country for a referral fee. So maybe a way to get clients and stuff there. So those are good resources to keep in mind. All right, my last bit of humor, and then we'll go into Q&A here. It's a tough market out there. We've all been dealing with a lot of interesting things the last, well, let's say more than the last 3 years, the last 10 maybe. It's been very interesting, but I love real estate agents because we always find a way no matter what is going on in the world right now. Anyone want to buy a house? Okay. That's the end of what we've got here. So let's open it up for any questions. Anybody want to take it off of mute and ask a question or put anything in the chat? I don't see anything we've got there. And we'll go through it.
Craig, can you hear me okay?
I've got you.
So I'm just going to throw out something for the realtors here in the conference room, but also that are on the website. So again, I'm going through the first one I had was easy peasy. We closed in 42 days because it was somebody that could have paid cash, but why pay cash when you can assume a loan at 2.75? So that was an easy one.
That's a very good example of financially savvy people that do this. Yeah.
And another great thing about marketing, but all the things that you said can go wrong is the one. And I don't know if Sally's on this call today, but she and I are going through this one. Great buyers and sellers are being very flexible. We're just working with one of those small service companies that, I had this vision of that they're in a trailer with two people, processing this stuff, because one of them quit and it took us 4 weeks to get another underwriter to review the file. So,
Yeah, and that when you get in those situations, those are the part we start walking the clients through the complaint process to the government organizations.
But to your point is and this, I think the realtors will understand, we all know the value of our strong lenders where they put a package together, especially with our difficult clients that maybe are self-employed. Or they're not quite in the box, and a good lender knows how to finesse the file before it goes to underwriting. I will tell you, if you're representing the buyer, at least what I'm finding out right now on this assumption is you're just dealing with the paper pusher on the other end. They're not worried about putting the package together, finessing it. They're just checking boxes. And basically, you're going to have to be the one to help your client get all the paperwork going. Where, I mean, for $100, I would have loved to have paid you and already, had this file together and would know for sure we got a strong client. But also, I think it would have gone through their system faster if it had already been put together and all the boxes had been checked correctly, to your point. So that's, to me, the real value. You can't speak to your competition. I can, because I've researched them. Most of them are charging 1% on the offer price, not the assumable, but the offer price. And they don't have this $100 to see if your person is qualified or not. That's a huge position and makes these assumptions not near as scary. So that was the last of my commercial for you, my non-paid comments, but I am living the nightmare right now. So
I'm sorry you're going through that. There's a couple of interesting things you said there that I'll address. First, I will say, we're very careful. We don't use the word qualify. We don't offer financing, right? So we're here to look at it from the eyes of, is there anything we see that the servicer who does the approval would kill this deal on, right? Now, the nightmare that you're dealing with, where you said, I think you used the term, right, a paper pusher there. Keep in mind, like a lot of these servicers, like I feel a little bit for them in that they didn't know this market was coming. They weren't prepared for it, and they don't generally have the people internally that people who originate loans normally do, right?
True.
And so we have several servicers that have thanked us because, like, we have seen scenarios where they maybe were going to reject a file, but what the grounds that they were going to reject it on was wrong, and I mean, I've said this to servicer. If you kill somebody's deal and you cause them a financial loss, who do you think they're going to sue? Right? And so, they don't want the liability of messing this whole thing up and creating problems for people. I don't think. I mean, I guess some places might value the getting the loan off the books better, but you know, yeah, there's a lot of change in this area in this new 3-year old now, but still relatively new marketplace, and we're just out here to kind of help everybody get through it with the least amount of brain damage, the greatest amount of success. Because, gosh, what kind of reviews are your buyers going to give you to their friends and family when they tell them, oh yeah, I bought a house at 2.5%, and I saved $1,000 a month in my payment, and it wasn't as easy as a new loan, right? We all know new loans are probably going to get done in 30 days, right? But it's still worth it. The amount of savings is huge. So we're just happy to be part of it and helping people. And we appreciate to present to people like you. And we're always open for easy to reach for questions. Most calls into the office, you're going to get me. My role is I don't actually touch any of the files. I don't have that kind of experience. My role is to protect my processors who are experts in this. So general questions I'm answering and dealing with, and I handle marketing and other stuff like that. But you know, we're very, very simple to reach. And if you run into a problem, we're just here to help. So
Why do the assumptions take longer than a conventional purchase? Yeah.
yeah, I think it just simply goes back to when you're doing a new purchase, right? There are thousands and thousands of loan originators out there that have been doing these forever that can get you through a simplified process. Just like a short sale, say, in an assumption, you're dealing with the servicer. There are a lot of servicers that originate loans, but there are many that they just specialize, I think, in just servicing, right? Just collecting the payments, basically, right? And so they don't have necessarily as wide a department and a reach for doing this process. And so a lot of them have started to staff up because they are getting volume. They are now getting big volume on these across the nation. And once again, they are getting better. I told you that the worst case scenario in the timelines, but we do have several that are getting it done in 25 to 45, right? So there's not a guarantee that it's going to take 60 days or 90 days. We're seeing very few deals go much beyond 70 days anymore. But I'll give you an example of weird things that can happen that do make it go longer. We're all familiar with lenders selling loans. Several deals, we've been in the middle of an assumption and they sell the loan to another servicer. And then you start over. We hate it. We don't see it a lot. It's very rare, but at least 3 or 4 times we've seen it happen. And we are all like, oh gosh, okay, that's no fun. But yeah, I think if you come into this and you prepare for the worst, but you expect the best, you know, a lot of people are pleasantly surprised that it didn't go and it wasn't this nightmare. You know, we all talk to each other as agents across the nation, right? And, you know, if you're talking to somebody who did one in 22 or early 23, yeah, it was a lot worse than somebody who did one in 25. You know, I mean, almost all of the deals that and we were involved with maybe 50 to 70 across the nation at any given moment, right? We don't have anything anymore that what hasn't come into the pipeline probably beyond early February. So most of them are moving along pretty good now.
You know, you mentioned this on the get-go. You know, 60% of our market, from what we can track, is below 4% interest rate. So for my fellow Lake Houston realtors that are on this Zoom call, and y'all here in the room, but I just finished doing the numbers for community impact, and I hate to say this, but across all 6 zip codes in Lake Houston, we were down in March of 2025 from March of 2024. And we all know 2024 was one of the worst years since the 80s. So this opens up, I think, another market for us. And I love the little tips that you gave us. And if we just aren't scared of it and we have resources, I think we can open up some of this marketplace and get people kind of off dead center.
You know, well, we're coming up on our hour timeline here, but if you've got, just talking about size of market, if you've got a second, I will show you something cool with the Assumable platform. I'm logging into it. Let me share it.
We're ready.
Oh, it's asking me to do things that I don't want to do right now. Come on, how do I get out of this? You know what? Unfortunately, I'd have to do this for you, I think, at a different time. It's going to ask me to go through. This is new stuff since I've last logged in, but I can go into the Houston market in here, in this platform, this Assume list, and I can go off market and I can show you how many properties in the Houston market are carrying an assumable mortgage. And I did this actually for Houston, I want to say maybe a month ago, and it was something like, I want to say something like somewhere between 70 and 90,000.
Yeah, I can imagine.
Depending, so it's not small. So I will just say, if you want to look deeper into the size of the marketplace where you're at, there's ways to do it. You know, Old Republic can also help you, and you don't have to sign up for a platform like Assume List to do that. So I would talk to them first.
Good point. Awesome.
Anybody else have any questions?
Well, Greg, really appreciate your time. I hope everybody can see, Craig, that this is a new market for us to open up, and partnering with entities like you will allow us to be able to navigate this a whole lot easier. And one thing you didn't mention, I was going to throw out, for the buyer, you don't have to pay for an appraisal. So to that fee point that you mentioned, you know, they save whatever the appraisal fee is. So.
Yeah, the only time an appraisal would come into play is if you're doing gap financing. But that's the other thing, you know, when you're working with a seller, you know, they've got the asset the buyer wants. So leverage that asset to get them the top dollar. You could sell it for more than value, because I know personally, if I was buying a home and I was going to save $1,000 a month, I might be willing to overbid by $15,000 or $20,000, especially if I was going to keep it for the next 27 years and save, say, $400,000 on interest payments.
Good point.
So yeah, it's all negotiating skill, which we're hopefully all experts at.
And knowing the numbers, yeah.
Knowing the numbers, that's the key to anything. Yeah. Okay,
Thank
well,
you.
why don't we wrap
Appreciate
this
it.
up?
Bye.
And anything else, feel free to reach out to us. AssumptionSolutions.com, 719-527-3380. My direct email is craig@assumptionsolutions.com as well, or you can send an inquiry through the website.
Awesome.
Thank you.
Okay.
Have a great weekend.
You as well. Thanks a bunch.